In this video, we look at what's next for the Indonesian economy in the second half of this year, from tariff deals and trade diplomacy to domestic headwinds and monetary policy directions. One of the biggest stories in July was, of course, the breakthrough of the US-Indonesia tariff agreement. Indonesia successfully negotiated down its reciprocal tariff rate from 32% to 19% after weeks of back and forth negotiation with Washington. In return, the Indonesian government agreed to remove tariffs on almost all of US goods imports and unlock market access in areas like vehicle safety standards and ICT imports. But this deal was just not about the headline numbers. It was also backed by major commitments. These include, among others, a commitment to purchase 50 Boeing jets, over $15 billion in US energy imports, and about $4.5 billion in agricultural goods, including wheat. Indonesia also pledged to relax local content rules and deregulate import procedures for strategic sectors like fertilizers, chemicals, and forestry. While the headline tariff still doubled from the original 10% baseline, the agreement offers Indonesia some breathing space, especially compared to regional peers facing steeper or even unresolved tariff rates. The government is still lobbying for exemptions on key goods not produced in the US, such as palm oil, cocoa, and certain minerals. In addition, it is pushing for greater clarity on transshipment rules. While the tariff agreement brings some clarity, broader trade uncertainties remain, and this could weigh on Indonesia's external outlook, making domestic momentum and policy response even more critical in the months ahead. Back home, we expect Indonesia's economy to grow 4.7% this year, down from 5% last year. The recovery remains uneven. First quarter GDP came in at 4.9%, and our tracking estimates suggest that second quarter growth will be slightly lower at around 4.8%. Household demand remains weak. Retail sales growth eased to 1.2% year-on-year in the second quarter of this year, again down from 2.8% in the previous quarter. Well over 24,000 job layoffs were also reported by May. Investment has also slowed, with gross fixed capital formation up just about 2.1% in the first quarter of this year, compared to 5% in the last quarter of last year. To help cushion this, the government has rolled out targeted stimulus, including transport subsidies, food assistance, and cash support to low-income workers for the period of June and July of this year. It is also in talk to prepare similar measures ahead of the year-end holidays. While the immediate growth boost may be modest, these efforts are expected to help stabilize purchasing power and lay the groundwork for a more sustained recovery. Bank Indonesia has stepped in with 3 cuts this year, and most recently in July, bringing the policy rate down to 5.25%. We believe the case for further easing remains intact. Headline inflation just averaged 1.2% year-to-date, and we expect it to remain broadly stable, averaging just 2% this year, which is well within Bank Indonesia 1.5 to 3.5% target range. Core inflation has softened, and the currency remains broadly stable. To that end, we see room for Bank Indonesia to cut its policy rate further by 50 basis points for the remainder of this year, bringing it to 4.75% by year-end. Indeed, in its July meeting, Bank Indonesia sounded dovish and left the door open for further rate cuts, adding that BI will make an all-out effort in encouraging growth and lending, while continuing to take calculated risk decisions. Looking forward, trade diversification is key policy theme at the current juncture. Indonesia is actively expanding global partnerships, including joining BRICS, pursuing OECD accessions, and progressing FTA talks with the EU and other economies. In short, Indonesia's outlook for the rest of 2025 remains mixed. Global risk and domestic headwinds persist, but the policy response so far has been timely and targeted. The focus is now then on execution and reform delivery, as Indonesia navigates an increasingly complex global environment.